So, Eric, budget 26. It was a big one, biggest one I've seen in decades.
Sure was.
You want to talk to a few of the key points?
Yeah, so typically in a budget, what we see is some really minor tweaks around taxes. You might see some small changes to personal tax rates, for example, and you'll see some commentary from the government around where their spending initiatives are and the general position of the budget. What we saw with the 2026-2027 budget were significant changes, and I would say changes that weren't expected from practitioners. And these changes were significant, so particularly around capital gains tax, the removal of negative gearing in certain scenarios, and what I'll be talking to you about today, which is the 30% imposition of tax as a minimum tax on discretionary trusts.
So we look after a particular style of client. We've got clients that are investors in business, they're employees, high net worth, so a variety of clients. Do you see this impacting on different clients in different ways?
Yeah, so we've worked through the scenarios on our client base, and from our perspective, we've seen some outcomes that we're not sure whether the policy was designed to create those outcomes. When we reviewed the budget papers, there were some statistics that were provided with respect to discretionary trusts. So 90% of all discretionary trust income is only distributed to 10% of the Australian population, and 90% of private trust wealth is only held by 10% of Australia's high net worth families. So this policy was really designed to try and capture more revenue from those high income families. But what we've seen with the outcome of the policy is it actually could be detrimental to someone who's on a lower level of income. So to put that in perspective, if you earn less than $225,000 right now, you're paying an average tax rate of 30%. So if you're earning less than that, by imposing a minimum 30% tax, you're actually worse off under the proposed changes, because you've got a minimum tax of 30% that's going to be imposed on your family income. So what?
So you talk about a family income of 225,000.
Yeah.
Most of our clients that are operating as a family structure, investment, business operations and the such, there's normally 2 or 3 adults in that household. So we're actually talking $450,000 to $675,000 income.
Yeah.
So this impacts on anyone who's earning less than $675,000 a year, which is pretty much all of Australia,
Yep.
You'd think.
Yep. And I mean, the narrative coming from government is they wanted those high level families to be taxed as an ordinary worker. And when they refer to an ordinary worker, they're referring to someone who pays a marginal rate of tax of circa 30%. But that doesn't take into account that the staggered brackets, which means when you're on lower incomes, you're actually paying a lower rate of tax.
So picking out amongst our clients that are impacted by this, who are impacted the least by it?
The least impacted are actually the high net worth families who are only distributing to beneficiaries that are already on the top marginal rate of tax. Now, what I haven't talked about is corporate beneficiaries. So when you distribute to a corporate beneficiary under the new regime with a minimum 30% of tax, they will not receive a credit for the 30% of tax that the trust has already paid. It is going to be administered as a non-refundable tax offset, and a company will not get the benefit of that non-refundable tax offset of tax that the trust has already paid. So in effect, a company, if you distribute income to it from a discretionary trust, will not only pay tax at the trustee level at 30%, but it will pay an additional tax at the company level of either 25% or 30%. So you automatically have a minimum tax paid by the company of, call it 55%, but that doesn't take into account that you then have to pay that income out of the company, which will be taxed again as dividends in the hand of the shareholders of the company. So that rate of tax could be quite high.
So we use those structures across our client base for clients of a variety of financial positions, including high net worth, but also a lot of medium income families running a small business, earning a quality income for their family. And we use it on occasions for lower income families that might be experiencing some extreme
Yep.
outcomes or planning to have extreme outcomes, wealth transitions, deaths and estates and such.
Yep.
Out of those three groups, who's facing the greatest risk of these structures being less attractive?
Yeah, no, it's a very good point. So we have those clients because trusts serve a purpose. Generally, two purposes that we use them for is one, for estate planning purposes. It's very easy to transfer a trust from one generation to the next because it just involves transferring the trustee of that trust so that the next generation can receive those assets and hold the trust. The other benefit of using a trust is it creates asset protection. So generally you don't want to have assets in, say, an individual name or in another structure such as a partnership that's exposed to risk. You want to protect it, and a trust to an extent does provide that level of protection. So we've structured these clients, the low income, the SME businesses on the smaller side of trading businesses into trusts to obtain those benefits. What's happened now is the minimum 30% tax suddenly makes that structure unattractive. Now, it's not the be all and end all because the government has said, okay, you can restructure a trust, and from 1 July 2027, they're going to give us some options as to how we do that. There's already some restructure relief that's available under small business CGT concessions and the small business restructure rollover, which we've used for our clients. There's going to be a new raft of rollovers that come into place to allow these SMEs and you call them investment entities to transfer out of a trust and into a company, or out of a trust, a discretionary trust, and into a fixed trust. The problem we have with WA is WA imposes transfer duty on business assets. So if you restructure a business and transfer that to another entity, if you're transferring goodwill, if you're transferring client lists, if you're transferring IP, that will also be subject to transfer duty in WA. So although the government has provided concessions with respect to capital gains tax, okay, there's no capital gains tax when you transfer a business to another trust, it's not getting around the fact that both WA and Queensland have to pay transfer duty on the transfer of assets. And to this date, the state government still hasn't provided any sort of comfort that they're going to remove transfer duty on business assets. So it's something that we're going to have to deal with as advisors. What I would recommend for clients in these positions is speak to an advisor. So speak to us and we can come up with some solutions that might be able to make that transfer more tax effective.
So generally, taxpayers that are impacted by these new rules, to some extent they're going to have to make decisions about changing their current structure or change their decisions about how to go forward with new enterprises.
Yep.
Is that something they'll be able to do themselves? I would think that this is a complex area of business advisory and they're going to need to have some people on their side.
100%. And I think what's come about with the budget is they haven't just changed one thing, they've changed three significant things. And I think all three of those significant changes need to be considered together. So when you're looking at the changes that came in with respect to capital gains tax, that also interacts very closely with the changes that they introduced with respect to the 30% tax on discretionary trusts. You also have to consider what you're going to do with property because there's no longer negative gearing benefits, and where's that going to be held? Which entities can still get access to what little is left of capital gains tax concessions?
We work with a variety of professionals. The changes that taxpayers are going to have to consider are going to impact on financial planners and their wealth, financial advisors, taxation advisors such as ourselves for structure and tax advice, lawyers for estate planning, for testamentary trusts, real estate agents for valuation purposes, valuers for valuation purposes. Yep. There's a whole raft of professional advisors that are going to be involved in making correct decisions
Yep.
around the impact of these tax changes. How do you see Abbott's role as coordinating those team of professionals?
I see our role in what it's always been in providing comfort to our clients that we have the ability to solve the complexities that inadvertently or on purpose were brought into the arena by these changes. So one thing which I've noticed following the announcement from the budget is it came across as being quite a simple announcement. Okay, you're imposing a 30% tax on discretionary trusts. Okay, you're removing negative gearing, and we're removing the 50% CGT discount on the sale of CGT assets. But what wasn't thought about were some of the inadvertent consequences of that. So for example, some of the exclusions that have now been announced, so income that's derived by testamentary trust, for example, that's now excluded from the 30% minimum tax. Navigating your way through these exclusions is where you need a professional advisor, because if you're going to try and navigate this yourself, you're going to miss some of the technicalities that and some of the nuances that are coming about, specifically with the changes to capital gains tax.
So we have a variety of clients. On occasion, those clients might be very similar on the surface to each other.
Yeah.
Similar income, similar assets. Is their advice likely to be the same?
No, it's never the same. I've never provided the same advice to similar clients. I've always found there will be something different. It could be something like you're advising a client who has a unit trust, and on the surface that's a fixed trust. When you look at the trustee, that unit trust might have discretionary units. So all of a sudden, your unit trust is subject to the minimum 30% tax on its income. So those sort of real subtle differences is across our entire client base. It's very rare to have two clients that would be exactly the same.
So is there a timeline that taxpayers should be looking at? You know, clients looking at when to do things?
Yep.
Is there key moments over the next few years that
Yeah.
will be important to them?
There's definitely some key dates. So for capital gains tax purposes, you've got until 1 July 2027 to at least think about your assets and what the removal of the 50% discount means. So we've already had clients come in and ask for that advice. And some of the outcomes there were quite interesting. Again, I don't think they were really thought through by the government. The next date is 1 July 2028. That is when the minimum tax of 30% is going to come into play on discretionary trusts. My advice would be to seek advice as soon as possible. I think if you're addressing these issues now with your advisor, you're going to put yourself in the best position to navigate your way through the changes before they come into play. I think it's safe to say they're definitely going to come in now. I know there's been a lot of talk in the media about just wait and see what happens, these are going to change, but I really think with the state of the government at the moment, we can safely assume this is all going to come through now.
A lot of doom and gloom. Is there any positives that came out of it about when the SPC, for instance, affects you?
So from a tax advisor perspective, I think the positive for me is we've been advising client groups for a long time now, and generally with our structuring, we would have a high net worth family group with corporate entities that we distribute to. That will no longer be possible because you can't now distribute to a corporate beneficiary. And what the effect of that's going to be is we're going to be distributing to the family members directly. So rather than, they're not going to be paying any more or any less tax, but rather than call it deferring their taxing point to a future point in time, all of that revenue now will be declared in the date that we distribute income up front. So I know it sounds like they're going to be paying more tax, well, they will be paying more tax up front, but I see it in a positive in that it's going to simplify the landscape around things like Division 7A, the complexity of company arrangements that we have in place. And theoretically, it should actually make the system, this is a big theoretical, it should make the system better at collecting tax up front.
So, Eric, I'm reading into this that there is a lot of planning required to be undertaken over the next 2 or 3 years.
Yeah.
There's also opportunities. Some of the structures that are in place have got a wind out time that is opportune.
Yeah.
The important thing, I suppose, is don't guess what is going to happen. Seek the specialists and get the best possible outcome out of what's probably an otherwise fairly average budget for taxpayers.
Yep, no, 100%. I think in the advisory landscape that we're in as of right now, these changes haven't actually come into play. So what clients should be thinking about right now is how do we continue to utilise what's currently still available to us. So these changes aren't coming into place for another 1 to 3 years. Let's take the time now to see how we can structure, do things, affect transactions now to utilise concessions that are now still currently available.